Michael Burry just dropped this image on his Twitter account a few days ago, and it shows that all the money that NVIDIA is investing into the hyperscalers or neoclouds is coming right back into NVIDIA as product purchases. Money is just circulating, and Dr. Burry says that this is inflating the AI bubble, and the end might be a little closer than we all think. And if we look at this image, it looks a bit confusing. There are a bunch of bubbles, money's routing in and out of companies. So I decided that today I will break this down into a simple multi-page document. So with that being said, let's get started. Money leaves NVIDIA and money comes back to NVIDIA. And that is the title that Claude came up with, and I loved it. Basically, what they're saying is that the AI boom is running in a loop. The same dollar keeps circulating back and forth from one company to another and comes right back around. And you can see it in this image. The yellow balls is the money revolving around from OpenAI to neoclouds to revenue and then back to NVIDIA as the companies purchase the products. So if you could remember one thing from this document, understand what a circular deal is. When a company gives another company money and that company goes around and uses the same money to buy the first company's product, the cash does a full lap around and comes back home. And I will use a few examples between NVIDIA, OpenAI, Microsoft, and whatnot to explain you what is really going on. And in this case scenario, let's talk about NVIDIA and OpenAI, because in first step, NVIDIA invests into OpenAI. Everybody knows about their $100 billion investment into OpenAI. And in step two, OpenAI then goes around and buys the NVIDIA chips with the same money that NVIDIA invested into them. Now, it makes sense because that's what they need the money for. But at the end of the day, NVIDIA is where the money came from and NVIDIA is where the money is going. And then NVIDIA will book that as a sale. And once NVIDIA books that as a sale, NVIDIA's revenue goes up and therefore the stock goes up. And this is happening on repeat. The same money that went out from NVIDIA's pocket is coming right back to NVIDIA's pocket. And in this case scenario, the stock is shooting up, which is making NVIDIA even a more valuable company. So therefore, they have more cash to spend out there. And remember, I said I'll give you multiple examples. So here are 3 different loops that are going around, which I could extract from that image Michael Burry posted. Loop number 1 is the OpenAI loop, the example that we were just using, but it doesn't just stop there. Once NVIDIA spends the $100 billion into OpenAI, OpenAI commits to buying NVIDIA chips. Then OpenAI routes another $300 billion to Oracle for cloud spending, and then Oracle is going around and buying the NVIDIA chips to fill their data centers. And this is how money is doing a full loop in this particular example. And here's the red flag. The investor and the customer are the same company. Demand didn't come from outside. NVIDIA helped fund that exact demand. Let's look at example number 2, the neocloud loop. NVIDIA does the same exact thing with the neocloud companies. They go out there and take a stake in the companies like CoreWeave. And in my opinion, this loop is a little bit more worse than the first example, because companies like CoreWeave, they take that cash, they go out there and take a loan on top of that cash. And then they're not just investing the cash they got from NVIDIA, they're also investing that loaned out cash to buy NVIDIA GPUs. And to make them feel a little bit more comfortable, NVIDIA goes out there and says, we'll promise to buy back any cloud capacity that you cannot sell. And if you look at the red flag here, which I just mentioned earlier, this is the riskiest loop that I can tell, because NVIDIA is basically guaranteeing demand for its own chip and the borrower is burning cash. So yeah, let that sink in for a moment. I understand why Michael Burry is so worried about this entire AI bubble and why he thinks that everything is coming down. I do feel like this is a house of cards that can get pulled any moment. But with that said, let's jump on to the third loop, which is the Anthropic loop. A very similar example, but with a few more parties involved. NVIDIA and Microsoft invest up to $15 billion combined into Anthropic. Anthropic turns around and commits $30 billion to Microsoft Azure Cloud, which is ran on NVIDIA chips. And then on the back end, Google and Amazon are also Anthropic investors and the chip suppliers at the same time. And in this case, when you look at the red flag, it says that it's the same pattern. It's just more players. The market ignored these loops when they were forming in the earlier years. But these loops and the money involved is only getting bigger as we move forward into 2026 and then 2027. There are many things that can go wrong in deals like this, but there are 2 risks that I want to talk about today. I want to clarify that none of this is illegal. these hyperscalers, these large companies have enough lawyers to make sure that they are doing everything right on paper. But I still want to take a step back and let you know that if you are a newer investor, or if you haven't gone through too many market cycles, understand that bubbles are formed in a way where nobody sees them coming. And while we're looking at this image posted by Michael Burry, these are the signs, these are early signs that we're just studying right now. So expect anything out of this. This could be nothing, but this could be everything. So the risk number one here is that, is the demand even real? If NVIDIA funds a customer who then buys NVIDIA chips, that sale isn't proof that the world wants more AI. It might just be NVIDIA's own money coming right back around. Sometimes the real demand and outside demand that is created artificially might look the same. You can't really differentiate that on an income statement. That can make revenues look healthier than they are and lure investors and lenders into overpaying for the same product. And risk number two, and this is the greater one of them all, and this is something that I am also worried about, that everyone is tied together. Because of the fact that these companies are funding each other, one company's problem becomes everybody's problem. And not just that, if AI demand overall just disappoints and doesn't improve as the years go on, it doesn't hit one firm. It ripples through the whole chain all at once, and it's going to be like dominoes. The AI demand slows, OpenAI cuts spend, clouds lose orders, chip sales drop, and then NVIDIA take hits at the very end. And you can see it's a house of cards that we are building right now. Let's do that again just for fun. All right, let's move on. Where the strain actually shows. You saw we went through 3 different examples earlier, and I told you the middle one is the one I'm worried about the most, and that is the weakest link. It's not NVIDIA, it's the neo clouds like CoreWeave. They are borrowing heavy against the money that they received from NVIDIA to buy their own chips. CoreWeave is currently spending more than it's making. They made $3 billion in one quarter and they spent 7.7 billion. They burned 4.7 billion in a single quarter. But then again, what is 4.7 billion dollar when the companies we're talking about are in trillions? 4.8 trillion dollar valuation for NVIDIA. Google is sitting at 4.7 trillion, Microsoft 3.1, Amazon 2.9, and OpenAI just shy of a trillion dollar. And then we have Anthropic. Personally, I can't not wait for Anthropic's IPO because I feel like that will be one of the greatest opportunities in about 5-year time frame. Not right now, but whenever the time comes. But that is for another video. Let's move on. Let's talk about the warning light. Our favorite 3 words from the Big Short movie: credit default swaps, the price to insure against NVIDIA not paying its debt. When it spikes, big money is getting cautious even while the stock stays calm. So you can see that we are slowly trending higher on the credit default swaps, and this started to trend up on the day NVIDIA floated backing OpenAI's financing. The cost to insure its bond jumped the most in a single day since the market began actively trading. As I said, these things are developed over time, but there are some days in the middle where you see something that is so confusing, you're like, hold on a second, and that is the moment here for NVIDIA. So is this smart or is this scary? Let's talk about the bull and the bear case for a second. Chips are genuinely scarce, so funding your customers is just how you lock in supply. So if you wanted your customers to just lock in the supply because there's not going to be enough product out there, this might be a good idea for you. NVIDIA stakes are small next to what these companies raise from everyone else. So if you are in a growing industry, you would really want to invest in your customer, just because if you see them in the trajectory of growth for the next 5 to 10 years and you have this cash sitting around and you're wondering where to invest, why not invest and flourish with the market? And in this case, why not invest into the companies that you are familiar with and you understand? Backing the winners early builds a moat rivals cannot match. Also a great idea. If you know you're early, you understand the product, you know where the industry is headed, you can do calculations better than anybody else because you are in the center of it all, then why not be the early investor, right? And lastly, Jensen himself has said that this is false accusation. The money is not circulating in the way you might think. And if you ask my opinion, as bullish as I am in the future of AI, this all just seems a little sus to me. I'm a little more cautious on the bull side. So you do your own math. Let's talk about the bear case. Funding their own demand is inflating their revenues. The neo clouds are burning cash and piling on debt backed by chips that lose value over time. And honestly speaking, this is a very interesting point that I've been thinking about for over a year or two. What happens to all of these chips that are just sitting in the data center? I mean, I can't even keep a cell phone for more than 2 years because it slows down so fast. Maybe I'm looking at this in a very simplistic manner, but only time will tell. One weak link can drag the whole interconnected chain down together. And if this happens, that means that Jensen was wrong to call everything ridiculous. And for the last bear case point, it rhymes with the vendor financing deals that preceded the dot-com crash. And Michael Burry is comparing this entire AI bull cycle to the 2000 era. We all know that the market crashed 77% between the year 2000 and 2022, specifically NASDAQ. And before the dot-com bust, telecom companies used the same exact trick, lending customers money to buy their gears, which inflated sales until the demand turned out to be thinner than it looked. When it broke, the tech-heavy NASDAQ fell about 77%, and it took roughly 15 years to climb back to the highs again. And that is the ghost that investors are watching for. That is what investors like Michael Burry are worried about. The bulls say this time the demand is real, and that is the entire debate. Who is going to be correct? We do not really know, and only time will tell where this market ends up in year 2027, 2028. If you have an opinion on all of this, I would love to read comments and I would love to see what you have to say. Personally, I am invested very cautiously. I have money in the market and I also have enough cash to be sitting on the sidelines. If we go in a bear market, I'll be just fine. And if we stay in a bull market, I'll enjoy the compounding that I'll get on my invested money. But please drop a comment. Hope this video was valuable. Hope this cleared some of the confusion on the image Michael Burry posted. And with that being said, I'll catch you on the next one. Thank you so much for watching.